24 seconds away from the opening bow this morning. Good morning to you. Your equity market looks like this, down 0.9% on the S&P, adding to yesterday's losses, taking some more weight off the Nasdaq 100. Nasdaq 100 futures down by 1.5%. This off the back of what we're seeing in the bond market, developing going into Fed minutes. Switch on the board and get to Treasuries. Yields higher, much higher, on a 10-year by 9 basis points. This morning, a sneak peek of life above 265. Right now, 263.69. In the FX market, euro showing a bit of strength, up 0.2% on euro dollar to 109.29, and crude 102, just about, up 0.2%, 102.15. That's the story in energy right now. Let's get you some movers. Here's Abby.
John, well, yesterday's sell-off is, of course, bleeding into today with stocks down sharply, especially the Nasdaq 100 down more than 1.5%, heading to its worst 2 days in 3 weeks. Not surprisingly, big tech really getting hammered, starting off with Microsoft, one of the biggest weights to the indexes, down 1.6% yesterday. Chips leading the slide. AMD today down 2.5%. We also have the likes of Applied Materials, the fab equipment maker, down 2%, and then Meta Platforms also down 2%. So fears of rising rates, this big move up for rates, pressuring valuation, causing investors to sell technology once again, John.
Abby, thank you. Energy stocks up by 0.75%. About a minute into this session, we're down 0.8% on the S&P. A little bit later this morning, 10:30 Eastern Time, a House subcommittee on oversight and investigations of the Committee on Energy, Commerce, the hearing as follows. Here's the title: Gouged at the gas station, big oil and America's pain at the pump. This is what Senator Manchin said going into this, and my thanks to Anne-Marie for sending this over. This is the quote: "I just pray to God they don't come here on private jets. Better to walk or hitchhike." That will be the first question that's asked. Anne-Marie in DC joins us now. Anne-Marie, just the title of this: Gouged at the gas station, big oil and America's pain at the pump. Is this a conversation, or are these guys going to get roasted for hours this morning to clip the thing, to play it out going into the midterms?
Well, I think it depends who's asking the question. So if it's a Democratic lawmaker and the title really tells you what's going to be asked about, they're going to talk about the profits that big oil companies have made, the higher stock prices, the higher oil prices, and potentially what we are not seeing, which is a decrease of everyday consumers, what they're paying at the gasoline pump. But then, Jonathan, on the other side of the aisle, the Republicans are going to want to make this about the Biden administration and what the fossil fuel industry feels like is a quite hostile approach to them. But it's an interesting time that this is happening, because at the same time, you do have officials really wanting to engage with Houston and the Permian Basin and get drillers back to work, because what they are seeing in the global oil market, which is higher prices due to the fact that many are shunning Russian oil.
About a month away from getting earnings as well from some of these names. AMH is going to be must-watch TV a little bit later. Thank you, as always. Katie Lyons, these stocks have had a monster run year to date.
Yeah, far and away the best performer in the S&P 500 on a sector level, John. And a lot of these companies have seen their stock prices do quite well. Just to run through the executives that will be at that hearing today, you have chief executives from Chevron, Exxon, Shell, BP America, Devon Energy, and also Pioneer Natural Resources. And I actually spoke with the Pioneer CEO, Scott Sheffield, alongside Guy Johnson back in February. And he said even if it's $150 oil, even if it's $200 oil, it will not change our production plans. And that had drawn the ire of President Biden last week in that speech where he announced the major tapping of the SPR. He said oil companies really need to stop prioritizing profit and returning capital to shareholders while the American people are watching. And obviously, John, the American people also are watching those pump prices tick higher and higher. The average price was up a full $1 in the first quarter. It's now around $4.16. To put that another way, it would take someone making the minimum wage 34 minutes of work to buy a single gallon of gas. That is the highest going back to 2008. So while it's pinching the pockets of consumers, especially on the lower end, it is not pinching the pockets of these energy companies. This is what you and Anne-Marie were just alluding to. Take a look at these numbers. Exxon expected to pull in $37 billion in net income in the current fiscal year. Shell and Chevron not far behind that. And Pioneer, who I was just talking about, a record $7.1 billion is expected. How do these companies navigate this earnings season when they have to talk about the money they are raking in, the money they are returning to their shareholders, and an environment like this one, John?
Kaylee, you mentioned Pioneer. They actually put that in the press release last week.
Yeah.
And they said one CEO even acknowledged that even if the price goes to $200 a barrel, they're not going to step up production. Katie, thank you. As always, Katie Lyons there. Just breaking down some of these moves ahead of this hearing later. Esti Dweck, simple question for you. Do you still have an energy overweight?
We still have a slight energy overweight, yes. We had the overweight before, actually already at the end of last year in our portfolios. So before oil prices really moved this high, we thought that the move higher post-COVID hadn't yet been reflected in a lot of these companies. We've taken some profits and trimmed that to some extent, but we do think that there is still some upside potential just from a purely, I'd say, earnings and again, catching up perspective in terms of the energy sector.
Jack Caffrey, they're about to get roasted on Capitol Hill. Would you be comfortable with being long those names?
You know, I think I think the industry's behavior has changed dramatically, and I think that makes them a lot more interesting today going forward. But to be an energy executive going in front of the House of Representatives is typically to be a punching bag. I think it comes with the game, or it comes with the role. And so I do think, when you look at the fact that they are returning capital, they are being disciplined with their budgets, and they are responding to a rapidly shifting regulatory environment. They're making the decisions you want them to make as an investor rather than a trader. And so I do think you need to actually be looking at getting a bit longer energy, even with this rally.
And Jack, would you view this in the same way we viewed some of the tech names? They go in front of Capitol Hill, they take a beating, but ultimately there's nothing they can do legislatively, and ultimately the earnings keep pouring in and those names keep performing. Is it the same thing, or is this different?
It's a little bit different because you certainly have, a lot of the energy complex has pressure politically. It has pressure from the rise of ESG. It has pressure from a whole host of from investors in terms of the amount of money invested that did not generate a return up until very recently. And so from that regard, I look at energy. It reminds me a lot of, say, perhaps tobacco 25 years ago in terms of it being very unpopular, very much willing to change how it behaved, and become very focused on recognizing that its future might not be as bright. And as a result, it becomes more of a cash return story. That, of course, means that you have to somehow link short terms to the long term. And I think the energy companies are going to point to, look, there's a lot of different regulation. I just can't flip a switch and suddenly produce an extra 1 million barrels. I need sand. I need truck drivers. I need steel. I need permits. I have to decide what happens with the natural gas emissions that will come out as I drill oil.
Yeah.
And so, give me your clarity. Give me rules that make sense and that I think can last for more than 3 months, and then I can respond prudently. But until that happens, hard to respond.
And those stocks have been up big time, up 38% year to date. Picking on Pioneer, given their recent comments. It's going to be very interesting to hear what they've got to say today. That stock is up year to date by 35%. Tony, can you help me understand how you're thinking about this phrase, demand destruction, which is a phrase that's been thrown around a lot at the moment, even more so given where energy's been trading?
Sure, Jonathan. And I think the key points on the energy sector are that they have become disciplined asset allocators. So the balance sheets are in strong shape. And that the commodity price environment, when you look out over the balance of this year and early into next year, is pretty healthy. So prices are going to remain high. The risks to supply are going to remain high. So we think that you're going to see a complex that stays certainly in the high double digits, maybe even north of 100. As you get further into late 23, and you talked about the Deutsche forecast for recession, we do see moderating growth. You do see that the cure for high prices is high prices, so there will be some demand destruction, both from a price perspective and from an overall growth decline. So we do think that the outlook as you move into later 23 certainly becomes more difficult for the energy complex.
The economic data in America still looks really decent, robust, resilient, call it what you will. Tremendous, some people might say, looking at the labour market data points. Esti, the equity market, though, is sniffing something out. The home builders in America are down year to date in a big way. The transports, more recently, and never mind the yield curve inversion, let's just focus on stocks. Esti, is something starting to brew, something starting to build for you?
Well, there really is that big question of growth and of a policy mistake. You understand that it's a very tricky position for the Federal Reserve. They need to re-anchor those inflation expectations. They need to bring inflation down, although higher rates aren't really going to bring down energy and food costs right now, and any supply chain disruptions that are still driven by China's zero COVID policy aren't going to be addressed either by higher rates. So this is really about the longer term and those expectations and bringing those back in. But it's such a tricky balancing act to avoid a recession that if we have hawkish minutes tonight, if the May meeting does have these 50 basis points and balance sheet runoff, and it is quick, that question about whether the U.S. can avoid a recession is going to become louder and louder. And I think we're going to see in that second quarter more choppiness in the markets, more questions about what the outlook is going to turn into over the second half of the year, and of course looking into 2023 already. So a difficult quarter ahead, but beyond that, as I said, I think the Fed is going to think about that growth question, is going to at some point pause and not push it too far in terms of the rate hikes. And that means that the second half should be much more comfortable for the equity market that, again, is already pricing in a lot of bad news and a lot of tightening.
Jen Caffrey, I wanted to give you the final word. In your notes, you said the one industry that provides the tell on the U.S. economy is housing. The home builders on the S&P down again today, and on the year to date, they are down by more than 31%. What's the tell there?
Well, look, the housing cycle is the economic cycle. It's a major employer. For most Americans, their home is actually their source of wealth. Tremendous employment. It works its way through, bank lending activity to get your mortgage. It goes through the building products businesses. It goes through the industrials. And we've had undersupply of housing for a decade. That said, though, mortgages a year ago were 2.5%. Today's data said a 30-year fixed-rate mortgage is 4.9%. So there's a price shock in order to buy a house. And so a slowdown in activity, I think, makes perfect sense. But you're still dealing with an industry operating from shortage. But right now, investors are conditioned to think mortgage rates spike higher, housing activity slows, sell stocks. And they are not necessarily giving the home builders the credit they perhaps deserve from having dramatically improved their business. But, you have to survive the short term to make it to the long term. And right now, it seems like there's going to be more pressure than not on the home builders.
Would you buy this weakness?
I think there are possibly better ways to get exposure to the housing trade because, let's face it, something in the order of 85% of home sales and housing-related activity are existing homes rather than new homes. And so I do think that the consumer is more likely to have to stay where they are rather than purchase a brand new home over the next several years, given the backup in rates until we can get mortgage rates back down. And that's going to come back to where Etsy was talking about the Fed minutes. What does the unwind of the Fed balance sheet look like? Is if you start actually increasing mortgage spreads on top of the backup we've seen in rates, that buying that first house is going to be something that people are going to have to talk about in their future, not their present.
Jack Caffrey, Tony Rodriguez, Esti Dweck, thank you to all three of you around the opening bell. Equities are down about 10, 11, 12 minutes into the session by more than 1% on the S&P. The Nasdaq down by 1.9%. Brutal in Europe. The Stoxx 600 down 2%. Take a look at the Euro Stoxx 50. We're down there by 2.8%. Guy Johnson will pick things up in about 20 minutes' time. Coming up, Western allies ramping up the rhetoric against Russia.
There must be, and there will be, severe consequences for all those responsible.
And Russia skirting even closer to defaulting.
People are being prevented from unloading rubles. That's artificially propping up the value. That's not sustainable. So I think you're going to see that change.
That was Secretary Blinken to NBC over the weekend, reflecting on the fact that the ruble is getting stronger, not weaker. And the headline crossed the Bloomberg moments ago this morning, the Russian ruble rallying back to a level seen before the war in Ukraine. Dollar ruble right now, 83.37. Damien Sassower of Bloomberg Intelligence joins us. Damien, you and I have gone back and forth on this. Just how much of a market is there? Do you take the line that Secretary Blinken is pushing and has pushed over the weekend?
Absolutely, absolutely. Secretary Blinken is square on the peg in terms of saying that the dollar-ruble cross rate that we're seeing, which is, by the way, the local dollar-ruble cross rate, i.e. the rate that's being exchanged locally within Russia, is not reflective of conditions. If you want to know where conditions are, Jonathan, you have to look at Russian credit default swaps. And you want to talk about jump risk, let's go there. Yesterday, 5-year Russian CDS was implying a probability of default of 99%, right, within 5 years. That's doubled overnight, based on the fact that Russia has agreed to pay the remaining balance on its dollar bonds in rubles. So that's basically the market all but implying a default. And what's happened here is that spread into the 1-year probabilities. We're now priced at 99% probability of default in Russia within the next year. So the market is telling us a default is imminent.
Let's talk about the why they send rubles. So this was the story we put out this morning. The ministry said it had to send ruble payments to the National Settlement Depository after foreign banks rejected its payments for bonds maturing this Monday and a coupon for notes due in April 2042. Can you run me through this, Damien, why it has been rejected and why we're starting to talk even more about a word you used yesterday, the logistics of this, not about ability and willingness, but the logistics of getting money from point A to point B?
Well, we know why it's being rejected, Jonathan. The JP Morgan appealed to the U.S. Treasury to ask whether or not it could process the $649 million in payment, and they said no. So the U.S. Treasury is basically preventing JP Morgan from making those payments onto creditors. That's what's triggered the move in CDS. And obviously here we are today planning for a default, just taking a step back and looking at what comes next. What comes next? So basically right now, actually 2 hours ago, the Credit Derivatives Determination Committee in London was meeting regarding Russian Rail's inability to pay a coupon on a Swiss bond back in mid-March. If the Determinations Committee does indeed determine this to be a default, monies will change hands. Once credit default swaps start changing hands, and in the case of the Russian sovereign, there are $41 billion of defaults outstanding. Once that all begins to change hands, the floodgates are open. And so for me and from my perspective, it's absolutely critical to keep an eye on that, see if anything comes out of that today. We know Alrosa, Oleg Deripaska, is applying for a special license to be able to pay his clients. He has been unable to do so. And also, just yesterday, Russia's second largest bank, VTB, has also tried to pay its dollar creditors in rubles because it's unable to do so in dollar or euro. So it's starting to metastasize and spread to the corporate sector.
Is this starting to spread beyond Russian assets? In the mix this morning, of course, we've got the equity market down, much lower, much lower. In the bond market, yields higher, much higher by 8 basis points on 10 to 263. Are you starting to see this bleed into EM in a way that it didn't do over the last month?
Yeah, definitely. So, what we have seen jump risk in places like Turkey, in places like Egypt, obviously a big importer of wheat from Ukraine and Russia. At one point, Egypt CDS had jumped as much as 1,000 basis points on a 5-year basis. I think it's back down to 550, which is kind of, it's normalized a bit. But certainly we're seeing sovereign CDS across the board starting to rise off the back of this move overnight. And that is a risk, right? Because what it is implying effectively is that many of these countries, many of these emerging markets don't have the funds to pay back their creditors over the medium term, and that things are going to get very, very painful for their economies. We already see local yield curves in places like Brazil and Chile inverted. Basically, the pace of rate tightening, the pace of rate hikes in many of these markets is choking growth. It's choking their economies, and I think that's a real risk going forward.
Damien, does it choke the Russian economy? And this is the key question, and let's finish there. You and I will talk further through the week, no doubt. Is this a problem for the creditor or the debtor?
I mean, my back-of-the-napkin estimates are calling for 30% peak inflation in Russia on GDP contraction of something on the order of 15 to 20%, Jonathan. That is obviously going to be very, very painful for households and corporates operating in Russia. And certainly if they're closed off from the international capital markets, it's going to be that much more difficult. So, yeah, the Russian economy is feeling it. Although, with that being said, the banking sector seems to have kind of normalized a bit in recent weeks. They're not actively going to the repo market. So that's kind of a step in the right direction in terms of locals in Russia, but my goodness, that economy has its work cut out for them.
Damien, what a tough time. Damien Sasson, thank you, sir, from Bloomberg Intelligence, just breaking it down. It's very difficult, complex, because this one's not about the ability to pay, the willingness to pay. It's about the logistics, getting the money from point A to point B. And as Damon has told us a million times, that's getting harder and harder and certainly not easier. This equity market's tough. The Nasdaq is down by more than 2%. On the S&P, we're down by 1.2% on the S&P 500. This with yields higher. Breaking down the sector price action, here's Abby.
Tough indeed, John. When we break down the sector action, it's pretty grim at this point because there's only a few sectors higher, and those are the true defensive sectors with one exception. Utilities, consumer staples, and healthcare, all true defense, and these sectors usually trade higher when yields are lower because the dividends look better, but people are so scared today, or at least cautious, that they're piling into those defensive sectors. Energy also higher, up with oil now slightly higher. Actually, it's flipped a little bit lower, so energy is higher too. But on bottom, once again, technology down 2% or more. Consumer services, communication services, tech, and consumer discretionary, all those mega cap. And you know, John, this is the story of the year, but you were talking about those home builders down so much on the year, and thanks for bringing that to my attention. So you have those home builders down nearly 30% on the year. You have the stocks down about 20% on the year, and you have the NASDAQ 100 down about 10% on the year, each headed toward the worst year since 2008. I know that the year is young, but again, this is a brutal picture given that the home builders, as you have been bringing up, and chips, leading sectors, perhaps a tell on a tough year.
Mortgage costs are going one way, Abby. They're going up in a big way. Abby, thank you. Coming up, your trading diary from New York. We'll run you through it and why the Fed minutes later this afternoon seem to be the main event. From New York, this is Bloomberg. "25 minutes in, this one might hurt a bit. We're down another 2% on the Nasdaq, down 1% on the S&P 500. The story like yesterday on repeat. Equities lower, treasuries lower, yields higher. This is the story, 2s, 10s and 30s. Your 2-year up another 2 basis points. That move fades a little bit, still up 8 on a 10-year at 262.19. That's the price action. Here's the trading diary coming up shortly. Secretary Yellen testifying before the House on Capitol Hill, followed by testimony from U.S. oil executives at 10:30 Eastern. The FOMC minutes coming at 2 p.m. this afternoon, plus another round of jobless claims tomorrow morning. Fed speak from Bullard, Bostic and Evans. Look out for the Fed minutes. That's all that seems to matter. Chairman Powell told us 3 weeks ago we'd get detail on balance sheet reduction in 3 weeks. 3 weeks later, time's up. Your minutes come a little bit later. Yields higher by 7 basis points on a 10-year to 2.62. This was the countdown to the open for our audience worldwide. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, April 6th. Here are the top market stories we are following for you at this hour. The debt sell-off deepens. Global bonds sink and the 10-year Treasury yield hits a 3-year high as the market braces for a rapid runoff of the Fed's balance sheet. The March meeting minutes drop at 2 p.m. Eastern. Growth warnings. Deutsche Bank becomes the first big bank to forecast a U.S. recession next year. Treasury Secretary Janet Yellen is set to warn of enormous economic repercussions from the war in Ukraine in testimony this hour. And piling on penalties, Western allies are coordinating a fresh round of sanctions on Russia, including a U.S. ban on investment in the country and an EU ban on coal imports. Energy remains the question mark for Europe. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, there's just about 4 hours to go until those minutes cross the wire, and that ultimately is going to be the big event of the day.
Is it, though?
I know our question of the day. We kicked this around earlier, Kaylee and I, trying to figure out exactly what our question of the day should be. Will the minutes move the market is the question we ultimately came up with. But Brainard's let the cat out of the bag, hasn't she? I really struggle with the idea, Kaylee, that anything is going to be more hawkish than that comes out of the minutes. I don't know. What do you think?
I think it's a really good question. I mean, we have heard from a chorus of Federal Reserve speakers, and they seem to sound more and more hawkish each time the next one comes out. But, Guy, to your point, a lot has been priced into this market already. So will we get anything that takes it even further, I guess is the question.
We get Bullard tomorrow, which should be interesting and entertaining. Let's kick it around a little bit more. Mike McKee's certainly somebody you want to plug into these kinds of conversations because he's usually the one having the conversations with the policymakers. We bring in Ira Jersey as well, our chief U.S. rate strategist, to get some market perspective on this. Mike, let's talk about the minutes. Brainard was super hawkish, and the whole conversation today has been more about what's happening with QT and the impact that that's going to have rather than actually what's going to happen with rates. But nevertheless, you put the two together, very hawkish message. Are the minutes going to be any more hawkish than Brainard, or is the cat already out of the bag?
I don't think it's going to be any more hawkish. I could be wrong, but at this point, we pretty much know what the Fed wants to do in terms of rates, and we kind of have an idea of the speed with which they want to do it. The question is sort of the technical aspects of how you do the balance sheet reduction, how much per month rolls off and how much is reinvested and how long do you think it'll take. We won't get an answer on how far they'll go, but we may get an answer to some of those technical questions, and that may lead the market to make adjustments, not because of hawkish or dovish so much as just getting themselves ready in position for what the Fed intends to do.
All right, well, let's talk about the technicals of the bond market as well, Ira, because what we've seen over the last 24 hours is actually that you're seeing more movement, not in the front end, the short end of the curve, but actually more in duration. The 10-year is now higher once again than the 2-year. That curve is no longer inverted. Is that to be believed that that will be persistent, or is it only a matter of time before we revert to inverting?
Yeah, I think ultimately we're going to invert the 2s-10s curve. I think what you're seeing today and what you saw yesterday a little bit was some position unwinds prior to those minutes that we're going to get at 2 o'clock today. And a big thing that we have to remember, Guy keeps on mentioning, will it be more hawkish? Will the minutes be more hawkish? I actually think that the minutes could be more dovish than the recent Fed speak, because remember, that was 3 weeks ago. And since the Fed meeting just 3 weeks ago, we've now priced in another 85 basis points of interest rate hikes by the middle of next year. So we've actually, the market has gotten more hawkish. Certainly the Fed speak has gotten more hawkish. So the minutes might be relatively dovish. But, to Mike McKee's point, some of the details of how runoff might occur, could certainly affect certain parts of the curve. But I think that this little respite from the flattening that we've seen most of the year is not going to last particularly long.
Ira, what does methodical mean, and what does it mean for the rate market?
Yeah, I think that methodical just means that they're not on a preset course in terms of magnitude of each hike, but that basically they want to be methodical in that they're going to hike at every meeting. And that's a little bit of a seed change from, say, the January meeting when they were thinking, we were thinking, and certainly I think members of the Fed were thinking that they would skip some meetings. But that doesn't mean that, what the magnitude of those hikes is going to be. So multiple 50 basis point hikes in a row is certainly a possibility. I don't think that they'll necessarily go that route, but 50 basis point in May, 25 in June, and then another 50 basis point in July is not out of the question. And I think it's that methodical kind of let's hike interest rates until we get toward their version of neutral is something that the market is certainly trying to contend with right now.
Well, so Ira, they're talking about the definition, if you can call it that, of methodical. Mike, can you help us define neutral? Do we really know where neutral is when we hear Fed officials talking about getting there or maybe above it?
Neutral is only something you can observe in past when we started to see inflation go up or the economy start to go down. But the Fed is looking in the area of 2.5 to 3 percentage points. for neutral. Their estimate was 2.5. It came down on a median basis to 2.4, but it's somewhere in that area. And the question then becomes, do you go above neutral and actually tighten policy in order to slow the economy enough and bring inflation down? And most Fed officials, they don't want to say yes, but they're saying they're open to that, and we may have to. They want to prepare the markets for that.
Okay, let's segment the markets a little bit here as well. Ira's talking about what's happening with rates. Let's talk about equities, Mike. Dudley wrote this really nice piece on the Bloomberg Terminal, this opinion piece a little bit earlier on, talking about the idea that basically the equity market is fighting the Fed right now. And the Fed ain't going to like it. Because the Fed knows that in order to effectively slow this economy down, it's going to have to hit the equity market, because that's kind of where US consumers largely store their wealth. What do you make of that argument? And do you think that's going to be something that the Fed is thinking about right now?
Well, I think it's a follow-on argument. The Fed is going to be tightening financial conditions. That's what they want to do, and that's where the equity markets are fighting against the Fed right now. They wouldn't target the equity markets as such, but they would try to, they would raise rates at a pace or over a period of time that would cause equities to lose, or cause earnings to go down, because the economy would slow, and that should bring equities down. And that may bring some more caution to the consumer spending. They've shown in the past that equity markets and housing both have an impact on the consumer, because they do have a lot of wealth in both.
Well, and something else that in theory could affect the equity market, perhaps bring equities down, Ira, is yields moving even higher. The market actually seems, I guess, relatively tolerant, considering we're already north of 2.5%, and that was an area that you would think maybe would be a lot more dangerous. How much higher can we go? Because I'm wondering at what point the equity market reaches its real breaking point on that front.
Yeah, I would be pretty surprised if, say, the 10-year yield didn't breach 3% at some point. I don't think it'll be particularly long. I think that once we hit 3-ish%, that's probably where the market is going to be thinking that the Fed's going to hike maybe to 3.25%, 3.5%, but then ultimately they're going to start to cut, because the probability of a recession sometime in late 2023 or into 2024, I think, is relatively high, and certainly the rates market is thinking that. So when you look at what the forward markets are predicting for where the yield curve is going to be and where rates are going to be, say, a year from now, we're looking at probably peak yields sometime the end of this year, maybe early next year, and then for 10-year yields maybe to rally back. And to Guy's point about financial conditions, I just want to mention, when you look at what's gone on with rates and where the mortgage market is now, we're at 5% mortgage rates, and so financial conditions are already much tighter. So even though the supply of housing is not particularly good, and certainly is keeping things tight, the ability for you to finance your housing purchase in at very low rates that we've become accustomed to is just significantly lower now. So we've already seen tightening of financial conditions even without the Federal Reserve actually raising rates a whole heck of a lot yet.
Yeah, well, and to that point, Ira, we were hearing from Patrick Harker as well. He's talking about housing demand, how it's still high, how we need more supply. Also that you're starting to see higher mortgage rates cooling housing some. So we'll continue to monitor those headlines. Thank you so much, Ira Jersey of Bloomberg Intelligence, as well as Michael McKee. Some other breaking news we did want to mention. We're hearing from White House economic advisor Brian Deese. He is speaking to reporters about India. He says the U.S. has warned India against alignment with Russia, and that U.S. officials have been, quote, disappointed with some of New Delhi's reaction to the Ukraine invasion. Obviously, India has an important not just energy relationship with Russia, but military as well, which makes their position in this perhaps a little difficult. But India kind of in the same group as China, those who are not speaking out against Russia's invasion of Ukraine. But coming up, of course, one of the consequences of that invasion has been rising prices, rising energy prices, rising prices across the board. So we'll continue about what that means, the conversation about what that means for the Federal Reserve. Will it have to tighten and cause a recession in order to control inflation? We'll discuss with co-chief investment strategist at JH Investments, Emily Rowland. This is Bloomberg.
the challenge that China poses and the risks that arise.
That is Representative Patrick McHenry speaking in the House Financial Services Committee, where, of course, Treasury Secretary Janet Yellen is about to begin testimony. The subject of the hearing is the state of the international financial system. Janet Yellen is set to warn of the economic consequences of the war in Ukraine, so we will continue to monitor those remarks. We're also monitoring what we're hearing in Fed speak, and of course, we're also hearing from Fed President Barkin, who was saying that the Fed may need to hike 9 to 10 times, that they're 9 to 10 times hikes away from the FOMC's estimate of a neutral rate, and that the FOMC could certainly move in 50 basis point increments if needed. So what clarity are we going to get into this around 2 p.m. Eastern time when we get the minutes from the Fed's March meeting, not just on the rate hike path, but also when it comes to the runoff of the balance sheet? Our question of the day, will the Fed minutes move the market? Let's ask Emily Rowland, co-chief investment strategist for JH Investment Management. Emily, market pricing has already come incredibly far. What would need to be in the minutes today to take it even farther?
Yeah, I think, what we heard from Lael Brainard yesterday in terms of the aggressiveness in which the Fed potentially aims to implement quantitative tightening has moved rates pretty meaningfully. In fact, we've seen some astonishing volatility across the rate backdrop already. So I think a lot of hawkishness is already priced in. I think investors certainly looking for some details around the Fed's plans here. But this rate backup has been really meaningful to us, and actually really, Kayleigh, surprising, considering the fact that there hasn't really been any economic data to move the Treasury market. We've just really had a series of Fed speakers that have contributed to the velocity in the move. Yep. And, when we think about the bond market, usually they're sort of the smart ones in the room, and we haven't seen that reaction here. In fact, we would think Treasury yields wouldn't be moving up so fast given the potential of recession across the globe right now.
They're usually definitely the bearish ones in the room. Always the smartest? Yes. We can debate that one. Emily, maybe the Fed and maybe the Fed speakers that we've been hearing from aren't seeing what they want in the markets. Financial conditions are really important in terms of the equation that we need to think about here. Bill Dudley, Mr. Dudley, writing a piece on the Bloomberg Terminal. I'm going to paraphrase. To be effective, the Fed will have to inflict more losses on stock and bond investors than they have so far, i.e. we need to drag down financial conditions. Do you think the market is fighting the Fed here? Do you think the Fed basically wants financial conditions to come down? In fact, it is a prerequisite for doing what it wants to do, that financial conditions do come down, and we're not there yet in terms of the pricing that we're seeing.
Yeah, I think not only across equity markets where we've seen a nice rally, albeit it's really been the more defensive parts of the market that are potentially reflecting this deceleration in economic growth, but I would look in particular at high yield bond spreads and even investment grade bond spreads, which have come in really meaningfully. We see an almost perfect correlation between financial conditions and credit spreads over time, and we're not seeing that tightening that the Fed would like. Look, they're throwing the kitchen sink at forward guidance here in order to, implement those tighter financial conditions, and it's not quite working as far as it relates to the equity market and the bond market. Now, of course, that's not their primary objective. We know the Fed has a dual mandate. They want to maximize employment and they want to maintain price stability. I think equity markets are kind of another, element of that that's tertiary to their main goals, but certainly they're watching that closely and not seeing that tightening that they'd probably like to get here.
Well, Emily, also the Fed would like to engineer a soft landing in theory. I'm wondering to what extent you actually think that's possible, or if we're now faced with a kind of binary outcome, one being a recession, one being inflation getting under control.
Yeah, the challenge to the soft landing narrative is unfortunately that we don't really have any historical examples of it. If you look back at prior periods in history where inflation has spiked to this degree, it's always been followed by a recession. So unfortunately, the Fed is probably going to need to put us into a recession in order to dampen inflation from here. There is hope. We could see if inflationary pressures recede, perhaps supply chains start to fix themselves. Perhaps we see inflationary pressures come off the boil. That could certainly allow the Fed to sort of pump the brakes instead of slamming on them. But there are a few developments that aren't helping. Certainly the resurgence of COVID cases in China is contributing to continued supply chain challenges. Certainly the Russia-Ukraine conflict, which has pushed commodity prices higher, is adding insult to injury as far as the inflationary backdrop goes. So there is hope, but our kind of thoughts around a soft landing are pretty minimal right now in terms of the probability there.
Emily, generally stocks don't like recessions. We're seeing what's obviously happening in the bond market as well. But if a recession is coming, and Deutsche is now out as the first major house to talk about the fact that we are going to get a recession in 2023, how do I want to be invested? Do I want to be invested?
Yeah, it's a really interesting dynamic now. I'm a big Bloomberg listener. I listen every day when guests come on, and I'm hearing more calls for an increased backup in rates, but then I'm also hearing these calls for an increased probability of a recession into 2023. And frankly, you can't really have it both ways, right? If you think that we're heading into a recession, then you actually want to increase the duration of your bond portfolio, not decrease it, which is what we're seeing investors do right now. And that's what we'll be doing as we move closer to late cycle here. This cycle is moving rapidly. We talked about that earlier before the session began here. And we want to be starting to think about positioning here more defensively. Hey, you still might want to own equities here. On average, there's another 10 months after the yield curve inverts until the market peaks. But there's an idea here that maybe rotating into more defensive parts of the market, higher quality parts of the equity market is going to make a lot more sense here as the economic backdrop proceeds and the earnings environment becomes a little bit less impressive.
Emily, we're going to leave it there. Emily Rowland, the Bloomberg Whisperer, joining us from JH Investment Management. Thank you very much indeed. Okay, coming up, NATO foreign ministers are meeting in Brussels. They're there to coordinate a new round of sanctions on Russia. Details next. This is Bloomberg.
Solidarity shown to Ukraine and its people. We think that all aspects of
Got that all day yesterday.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
So the US and its allies are coordinating on a new round of sanctions. They're doing so at a meeting in Brussels. Sanctions could include a bar on all new investments in Russia, amongst other things. Let's talk about what we should expect. Joining us now, Bloomberg's Washington correspondent, Anne-Marie Hordern. Anne-Marie, what do we think the package is going to look like? How far will it go?
Well, for the Europeans, they're going to start to touch energy now, which the United States has already done. So they are going to ban coal. And then altogether, there's going to be a ban, from what we heard from the United States yesterday, on new investment in Russia. So no longer able to do that. And then the Wall Street Journal reported a little bit more details on some of the financial institutions they're going to go after. So tightening a little bit of the sanctions on Sberbank, as well as going after Alfa Bank. And then also there's going to be more sanctions on individuals, government entities, state-owned enterprises, people that are connected to this, and their families. And potentially as well, we could see the sanctioning of President Putin's two daughters that we know of, that the Kremlin has on their website. And this would be Katerina and Maria, although he's gone to great lengths over the years to really protect their privacy and keep them secret. So these are the likes of the sanctions. As you can see, this is pretty much the same strategy that we've seen in the past in terms of what they're targeting, and now they're just making it a little bit longer and going a little bit deeper. What is still left potentially to target in the future, Anne-Marie? So the big one would be Russian oil and gas. So when you look at coal, Ursula von der Leyen is talking about the fact that coal is about $4 billion for Russia. But Russia this year alone will be making $321 billion, according to our calculations. It's up from a third of what President Putin was able to bring in from selling commodities last year. So that $4 billion really dwarfs how much he is making when you package it all together, namely from crude oil and namely from oil and gas. The issue right now is that Europe is incredibly divided. If we're going to see countries move quickly on Russian oil and gas, it's going to be unilaterally the way we saw Lithuania move.
We're just starting to get some headlines coming through. EU has announced more sanctions. Let me just make sure I'm getting these details correct. The EU has announced more sanctions on Russian energy. This is according to US officials. The US is to sanction Putin's daughters on new Russian curbs, full blocking sanctions on non-energy Russia. SOEs coming soon. The US hopes for maximum sanctions alignments with India, and the sanctions do not affect Russia's state-held energy firms. Those are the headlines that have just dropped onto the screen. We'll continue to analyze what is happening here. Anne-Marie, Katie's question is a really germane one. The US has already gone about as far as it can go. There are further sanctions that are being applied, but we're reaching the limits of what the US is capable of doing here without stepping in and effectively hitting the companies that are providing energy and financing that energy into Europe. How should we think about how we're going to ratchet these up from here? Clearly, this has been in response to what has happened in Bucha. The scenes coming out of Mariupol are likely to be grim, if not grimmer, than what we've seen here. Is there an expectation that Europe and the US are basically saving sanctions because they know that public opinion is going to get even harder on this?
I don't know if I'd call it saving sanctions. I think they're doing the harshest they can go with, at the same time, taking on what those repercussions and blowback will be in their economies. And it really comes down to oil and gas. You see the carve-outs they are making when they tackle this, and until Europe gets there, we're not going to see it. Is it Europe's last card to play, though? Thank you so much to Bloomberg's Anne-Marie Hordern in Washington. Of course, in Washington, we're continuing to monitor the testimony from U.S. Treasury Secretary Janet Yellen testifying in the House Financial Services Committee. We'll be bringing you those headlines as they come. This is Bloomberg. Welcome back to Bloomberg Markets. We're continuing to get headlines crossing on the sanctions that the U.S. and allies are putting into place on Russia. This fresh round of sanctions from the U.S., we now understand, will include sanctions on Putin's adult children, as well as Sergei Lavrov, the Russian foreign minister, his wife. So we will continue to monitor those developments. We also have to continue to monitor what is happening in these markets. Yields are up, stocks are down. That's basically what you need to know today. Abigail Doolittle of Bloomberg is here taking a closer look at that. Abigail, pretty brutal.
It is brutal indeed. We have greater than 1% declines right across the board here. That sell-off that started yesterday with those hawkish comments from Lael Brainerd continuing for a second day, the worst 2 days for stocks going back to March 8th or 7th, depending on the index. You can see the tech index is down more, and to Kaylee's point, yields higher, pressuring those tech sensitive, those rate sensitive, more rate sensitive sectors higher, lower as growth and valuation concerns become a big deal. Now, if we take this to a year-to-date basis, because the stock's down sharply over the last couple of days, but on a year-to-date basis, there's another sector to bring into the mix, but I bring it in because it's a leading sector similar to the stocks or the chips. So in blue, this is the home builders down sharply on the year, down more than 20%. We have the chips, the stocks down about 20% on the year, and the NASDAQ 100, while it's not showing here because this is a one-year chart as opposed to a year-to-date chart, it is down about 10%. Each of these indexes right now headed to the worst year since 2008. The year is young, but nonetheless not a great way to have the beginning of the year going. And to Kaylee's point on yield, let's take a look at the 10-year yield on the year because it is really pretty extraordinary here. A backup of 1.1%, close to 270 right now, a little bit above 260. You can see that resistance that we've been watching hitting right up on top of it, maybe above it at this point. Let's see, Guy, what's ahead? I mean, just every day seems to bring new surprises, but right now, lots of confusion, uncertainty, and frankly, stressed out markets.
Absolutely. The rate of change, eye-watering. How high will we go? That's the question that everybody's trying to figure out right now. What does the QT program mean in terms of yields as well? Abigail, thank you very much indeed. Let's turn our attention to what is happening with the oil market. You just include inventories hitting the tape, 2.42 million barrels. That's a build, not a draw. The market was expecting a draw. Oil company executives are also on Capitol Hill today. They're being questioned about soaring gasoline prices. Meanwhile, we've got to figure out kind of whether or not they're prepared to invest, whether the shale patch is prepared to invest. We've had this back and forth between President Biden and oil company CEOs for a while now. It gives you an idea, this next bit of sound we're going to play, the division that exists between the two sides still.
Regardless of whether it's $150 oil, $200 oil, or $100 oil, we're not going to change our growth plan.
One CEO even acknowledged that they don't care if the price of a barrel of oil goes to $200 a barrel. They're not going to step up the production.
Even if the president wants us to grow, I just don't think the industry could grow anyway.
They don't want to increase supply because Putin's price hike means higher profits.
It's all about the shareholders. Our shareholders own this company. They want a return of cash.
I say enough. Enough of lavishing excessive profits on investors and payouts and buybacks when the American people are watching.
What I like about that conversation is that it appears as if President Biden was watching us as well, Kaylee, because that conversation with Scott Sheffield, I remember it as if it was yesterday. He was making those points really clearly. Basically, we're supply constrained. We've got shareholders that want us to be disciplined. But things have moved on since then.
Yeah, I mean, that conversation was actually before Russia even invaded Ukraine back in mid-February. But we asked Scott Sheffield, even if Russia invades, if it disrupts energy flows, will Pioneer step in to potentially fill any of that gap? He said, no, we are sticking with our production targets, 5% growth at the maximum. That is our call, and I would imagine he'll reiterate that on Capitol Hill today.
I'm just happy the president's watching. Bloomberg's David Wethy joining us now to talk about all of this. Has the situation changed, David? We find ourselves in a situation, obviously, where we now have a war, a land war in Europe. Energy is increasingly being sanctioned by the United States, increasingly by Europe as well. Does that change the narrative for these shale guys? Does it change the narrative for the oil industry when it comes to what the president is worried about, which is high gasoline prices? Everybody sees it day in, day out. The sticker shock is enormous.
So far, no. And in fact, we had a peek at what they're going to tell Congress in their speeches that they released last night, and all 6 of the participants are echoing the same sentiments that they've been saying over the last month, not looking to increase production, still sticking to their 5% growth for these public companies. And you got an extra bit of insight from Scott Sheffield in his opening statements, where he talked about how if you look at the oil futures curve, it loses $25 a barrel over the next 5 years. So that's an indication of where the oil market thinks oil is going in the future and doesn't see this undersupply for very long. And so the oil companies are not incentivized at this point to start to put in production for these wells that will drill, that it will produce for 30 years if the oil price is going to go down in the future. So until what Devin has told me is what they're really keeping their eye on, in addition to investors telling them they don't want to drill more, is what this futures curve will be. And so if that ever changes and starts to rise again, because there's this fundamental belief that production will not meet demand for the long term, then these oil companies will go into more production. In addition to all that, they say that it's just taking longer now to get production out because of things like supply chain shortages, labor shortages. And so they're having a hard time, even if they wanted to right now, to turn the spigots on very fast.
Yeah, we're talking about the supply of oil, but these oil companies themselves also have supply side challenges, labor, just one example. As we speak to lawmakers on Capitol Hill, what is the role potentially of regulation here? I know there's a lot of conversation about the actual land that they are able to drill on, but could we see any regulation, any action on their ability to return capital to shareholders? Any restrictions on buybacks or dividends?
That'd be a good question. I would think a lot of that would get mucked up, through the congressional filing of bills. I'm not sure how much that could actually go through. It is worth pointing out that these guys have only really had this one explosive year last year in showing record free cash flow and returning cash and dividends to shareholders. Beyond that, they spent the last decade losing money, and that's why investors are so mad at them. So really, they've only had 1 year of doing this sort of thing.
David, did the SPR release disincentivize U.S. oil companies from doing more?
When we talked around to different people, yes, it does sound like it's a little bit of a disincentive, partly because you just sort of have more production out there, and but again, it's a very short-term blip on the market. I think for the most part, what you're hearing more that's just disincentivizing these oil companies is just no talk from the administration of streamlining permitting and allowing pipelines and drilling of wells to go any faster. If they hear that from the administration, that's more likely to get them more incentivized to drill more.
Well, and David, obviously primarily here we are talking about the public companies. Everyone testifying on the Hill today works for a public company. What are the private players doing?
They are going like crazy. They're as many rigs as they can get their hands on, as much cash as they can get their hands on to drill more. They are doing pretty much exactly what Biden would want. But of the pie, they represent about 35% of the U.S. production. So as far as them moving the needle, these private companies, they're not really able to do it like what these public companies could. The private companies are mainly drilling more so that they can look enticing to the public companies and get bought out.
All right, Bloomberg's David Wethey, great stuff. Thank you so much for joining us. Now, of course, as we are paying attention to that testimony in particular on Capitol Hill, we have to pay attention to other testimony as well. Treasury Secretary Janet Yellen currently is speaking before the House Financial Services Committee. We'll discuss her remarks on the economy with Veronica Clark, Citigroup Global Markets economist. This is Bloomberg.
I haven't looked into. I'll get back to you on that.